Imagine doing everything people once believed guaranteed stability. Studying for years, finding steady work, saving carefully, avoiding unnecessary spending, and still realizing that owning a home feels further away than ever. In many cities today, even people with full-time salaries discover that the price of a modest apartment rises faster than their savings account can grow. A person may save for years, only to find that by the time they are ready for a down payment, the same property costs significantly more than it did when they started. This creates a strange feeling that many younger workers describe with frustration. They are not only chasing a house, they are chasing a target that keeps moving faster than they can run. What makes this even more confusing is that previous generations often reached home ownership much earlier in life, sometimes on salaries that appear smaller when compared on paper. Yet, across many economies today, buying property has become one of the most difficult financial goals for ordinary households. Housing affordability indicators collected across advanced economies show that in many countries, house prices have increased faster than household incomes over long periods, especially in urban centers, where employment opportunities are concentrated. This means that even where wages rise, the ratio between annual income and property prices often becomes less favorable over time. The result is not simply expensive housing, it is a structural shift where ownership increasingly feels delayed, uncertain, or unreachable for large parts of the middle class. At first glance, many people assume this happened because houses became better, cities became more modern, or land simply became scarce. But the deeper explanation is much larger than construction costs alone. The modern housing crisis is tied to interest rates, urban growth, investment behavior, lending systems, and decades of economic policy that changed how property functions inside the economy. To understand why owning a house now feels impossible, we first need to understand that houses are no longer viewed only as places to live. In modern economies, they also became financial assets, and once that happened, the logic of housing changed dramatically. For much of the 20th century in many countries, home ownership expanded alongside wage growth, suburban development, and relatively affordable land outside growing cities. Governments often supported this through mortgage programs, public infrastructure, and zoning policies that encouraged large-scale residential construction. During those decades, rising incomes and expanding housing supply often moved together strongly enough that many households could realistically expect to buy property after several working years. But over time, something changed. Urban populations grew faster, economic opportunity became concentrated in fewer major cities, and land near employment centers became increasingly valuable. As more people competed to live near jobs, education, transport, and services, demand intensified in specific areas while supply often struggled to expand at the same speed. At the same time, mortgage systems became more accessible, which initially helped more people enter the housing market. But this created another effect that many first-time buyers did not notice immediately. When more credit becomes available, more buyers can compete for the same homes, and that often pushes prices higher. Instead of making ownership easier permanently, easier borrowing can increase demand faster than supply, causing property values to rise further. Historical housing data across developed economies shows repeated periods where falling borrowing costs supported stronger house price growth because households could qualify for larger loans than before. This meant monthly affordability sometimes looked manageable even while total property prices climbed rapidly. For buyers, low monthly mortgage rates made expensive houses appear temporarily reachable, but over time, the total debt required became much larger than earlier generations had faced. In many countries, this transformed housing from a gradual family goal into a major long-term financial commitment shaped heavily by debt. Another important shift happened when investors increasingly entered residential property markets. Once housing proved capable of generating both rental income and long-term capital appreciation, property became attractive not only for households, but also for investors seeking stable returns. Apartments, houses, and entire residential blocks increasingly attracted investment capital because they offered something many financial assets could not always guarantee: physical ownership tied to rising urban demand. This changed market behavior because first-time buyers were no longer competing only with other families. In many places, they also competed with investors who could buy faster, offer more cash, or hold multiple properties. In major urban markets, this effect became especially visible, where investment demand strengthened price growth even when wages failed to keep pace. Housing therefore began operating under two different pressures at once: a basic human need for shelter and a financial incentive tied to long-term wealth preservation. That combination made prices more sensitive to financial conditions than many people realized. When interest rates fell for long periods, borrowing became cheaper, investors expanded activity, and households increased purchasing power through larger mortgages. But because supply did not always grow equally fast, prices often accelerated further. This is why in many cities people now feel that even disciplined saving cannot catch up with the market. The problem is not simply that houses cost more, It is that the economic forces behind housing prices often move faster than ordinary household income, especially in locations where opportunity and demand remain concentrated. And once housing becomes tied closely to finance, wages alone are often no longer enough to explain price behavior. The real twist is that for many years, rising house prices were not always treated as a problem. In fact, in many economies, they were often interpreted as a sign of prosperity. When property values increased, homeowners felt wealthier, banks expanded mortgage lending, construction activity accelerated, and governments often benefited from stronger economic momentum. Rising housing markets created jobs in construction, materials, transport, legal services, and banking. Entire sectors of the economy began depending on active property markets. This meant that housing stopped being only a social issue and became a major economic engine. But once property prices became closely connected to growth, another hidden pressure appeared. Many institutions quietly developed incentives for prices to remain high rather than fall sharply. Banks earned long-term returns from mortgages, investors benefited from appreciating assets, and homeowners often supported price stability because much of their personal wealth became tied to property value. This created a system where falling prices could hurt confidence across multiple sectors at once. Historical housing crises show how powerful this connection became. During the global financial crisis of 2007 to 2008, collapsing housing values in several countries did not remain limited to homeowners alone. They spread directly into banking systems, lending markets, and global financial confidence. Mortgage-backed financial products lost value, banks faced major losses, and entire economies entered recession. That crisis revealed something important. Housing had become deeply connected to the financial system itself. Since then, many countries have treated housing stability as an economic priority, because large disruptions in property markets can quickly affect employment, credit, and national growth. But stabilizing housing markets does not automatically restore affordability. In many places, prices recovered faster than incomes after the crisis, especially once central banks lowered interest rates to support economic recovery. Lower interest rates made mortgages cheaper again, which increased demand, but supply constraints remained in many urban areas. As a result, prices rose again, sometimes even faster than before. This is one reason younger buyers often feel they entered the market at the wrong time. By the time wages improved after economic slowdowns, house prices had often already moved ahead again. Another powerful factor behind the housing crisis is land itself. Contrary to what many assume, construction costs alone do not explain why urban housing becomes expensive. In high-demand cities, the most valuable component is often land near economic opportunity. Land near major employment centers, transport systems, universities, and commercial districts becomes limited because location cannot be expanded the way production can. A city can build taller buildings, but it cannot create unlimited central land where millions of people want to live. This means location value rises when economic opportunity concentrates geographically. As technology and services increasingly cluster around major cities, housing demand intensifies exactly where supply faces the strongest limits. Zoning policies then add another layer. In many cities, construction rules, height limits, approval delays, and local planning restrictions slow the speed at which new housing enters the market. Even when demand rises strongly, new supply often arrives too slowly to reduce pressure meaningfully. Economists repeatedly note that where housing supply remains restricted while population and jobs grow, prices tend to rise persistently. This explains why two cities with similar incomes can experience very different affordability outcomes depending on how quickly new housing can legally and physically be added. Mortgage systems also change the psychology of pricing. Buyers often no longer think first about total property price. They think about monthly affordability. If lower interest rates reduce monthly payments, buyers can qualify for larger loans, which allows sellers to ask higher prices because demand expands. Over time, this means lower borrowing costs can raise prices instead of making ownership permanently easier. A family may still manage monthly payments, but only by accepting far larger debt than previous generations carried. This creates the feeling that ownership exists, but only through decades of financial commitment. In some countries, mortgage periods expanded further, stretching repayment horizons across much larger portions of working life. This means ownership remains possible, but increasingly tied to long-term debt exposure that earlier generations often reached with lower price-to-income ratios. At the same time, wages rarely move with the same speed as housing finance. Salaries usually rise gradually, while borrowing capacity can change quickly when rates move. This is why house prices often react faster than incomes whenever financial conditions shift. A small reduction in mortgage rates can immediately increase what thousands of buyers can bid, but wage growth takes years to create similar purchasing power. Investors understand this dynamic well, which is one reason property remains attractive during low-rate environments. Rental demand adds further support because even when households cannot buy, they still need housing, making rental income relatively stable in many cities. This means property often attracts capital even when affordability for first-time buyers weakens. The result is a market where prices respond not only to family demand, but also to financial strategy, credit conditions, and long-term expectations. Once these forces combine, the housing market no longer behaves like an ordinary consumer market. It becomes a place where shelter, debt, investment, policy, and long-term wealth all interact at the same time, often pushing ownership further away from the people trying hardest to enter it. Another reason the housing crisis feels so personal is that property prices do not rise in isolation. They rise while other essential costs are also increasing at the same time, which makes the gap between income and ownership feel even larger. A household saving for a down payment is not only competing with house price growth, but also with rent, food, transportation, energy costs, and sometimes student debt or family responsibilities. This means the ability to save is shaped by every other pressure in the economy before housing even enters the final decision. In many major cities, rent itself has become one of the biggest barriers to ownership, because people trying to save for a future home are often paying a large portion of their monthly salary simply to remain close to work. When rent absorbs a significant share of income, savings grow slowly, and slow savings become a serious disadvantage in markets where prices move quickly. This creates a difficult cycle. Households rent because buying is expensive, but renting itself reduces the speed at which buying becomes possible. Over time, many first-time buyers discover that the market has moved further while they were still trying to save enough to enter it. This is one reason younger generations often describe home ownership not as delayed, but as constantly postponed by forces they cannot fully control. Urban concentration strengthens this problem further because modern economies increasingly reward geographic proximity to opportunity. High-paying jobs, advanced education, specialized healthcare, business networks, and major transport systems are often concentrated in limited metropolitan areas. As more people move toward those centers, housing demand intensifies exactly where land is already scarce. Smaller cities may remain cheaper, but they do not always offer the same income opportunities, which means households often face a trade-off between affordable housing and economic opportunity. For many workers, the higher salary available in large cities is partly canceled by higher housing costs, leaving little real advantage after rent or mortgage payments. This is why even income growth in strong urban labor markets does not automatically solve affordability. A salary may be higher in a major city, but so are the property prices competing for the same limited space. Another major factor is how expectations influence markets. Housing is unusual because buyers do not only react to current prices, they react to what they believe prices will do next. If people believe houses will become even more expensive next year, many rush to buy earlier, which itself increases present demand and pushes prices higher. Investors act similarly. If property is expected to remain scarce and valuable, investors often continue buying even when prices already look high, because they believe future gains will justify current costs. This expectation-driven behavior creates momentum that can continue for years, especially when supported by strong lending conditions. In many markets, people no longer ask whether property is cheap. They ask whether waiting will make it even less affordable. That belief alone can keep demand strong, even when affordability weakens. Central banks indirectly influence this entire cycle through interest rate policy. When inflation rises, central banks increase rates to cool borrowing and slow price pressure across the economy. Higher rates make mortgages more expensive, which can reduce demand and slow housing markets. But this effect creates a new difficulty for buyers. Even if property prices stabilize or decline slightly, the cost of financing becomes higher, which means monthly affordability may still remain difficult. In practical terms, a cheaper house financed at a much higher interest rate can still produce monthly payments that feel unaffordable. This is why many first-time buyers feel trapped between two unfavorable conditions. When rates are low, prices rise quickly. When rates are high, borrowing becomes expensive. In both cases, ownership remains difficult. Historical mortgage data repeatedly shows that housing affordability depends not only on price levels, but also on financing conditions. These two variables rarely improve perfectly at the same time. Another hidden pressure comes from how housing increasingly functions as wealth storage across generations. Families that already own property often accumulate wealth because their homes appreciate over time, while families without property must save from income alone while prices continue rising. This creates widening differences between households that enter ownership early and those that remain outside longer. In many cities, parental support has become a major factor for first-time buyers because inheritance, family savings, or help with down payments can determine whether entry becomes possible. For households without that support, wages alone often feel too slow relative to market movement. This creates the impression that ownership is no longer determined only by work, but also by timing and existing wealth. This leads to a larger realization. Housing has gradually become one of the clearest examples of how asset growth can move faster than earned income. A person can work harder, earn more, and still struggle to match the pace at which property values increase because the market responds to finance, land scarcity, investor expectations, and policy decisions far beyond any individual salary. Once that becomes clear, the housing crisis looks less like a simple affordability problem and more like a system where multiple economic forces are pushing against first-time ownership at the same time. And this is where the deeper truth behind the housing crisis finally becomes clear. Owning a house feels impossible today, not because one single part of the economy failed, but because housing now sits at the intersection of nearly every major economic force at once. Wages influence affordability, but so do interest rates, urban planning, global investment flows, land scarcity, construction speed, demographic pressure, and long-term policy decisions made over decades. A buyer entering the market today is not simply purchasing shelter. They are entering a system shaped by credit conditions, financial expectations, and the accumulated effects of years in which housing increasingly behaved like an asset before it behaved like a basic need. This explains why many people feel confused when they compare their situation with previous generations. Earlier generations often bought property in environments where house price to income ratios were lower, debt periods shorter, and financial competition weaker. In many cases, housing demand existed, but investment pressure, global capital movement, and urban concentration had not yet reached the same intensity. Today, a first-time buyer often competes inside a far more complex market where property attracts not only families, but also investors, long-term wealth strategies, and financial institutions that view housing as part of broader capital allocation. This does not mean ownership has become impossible everywhere, but it does mean the path toward ownership is no longer shaped by salary alone. In many countries, households now require larger down payments, longer mortgage commitments, and far more patience than earlier generations needed. Even when wages improve, the size of debt required often changes how ownership feels psychologically. A person may technically qualify for a mortgage, yet still hesitate because repayment stretches across decades and uncertainty about future rates, job stability, or inflation remains high. This psychological pressure is one reason housing feels harder even when financing exists. Ownership no longer represents only achievement. For many people, it also represents long-term financial risk. Governments understand this tension and have tried different responses, from first-time buyer support to social housing expansion, zoning reform, and mortgage regulation. Some policies help temporarily by increasing supply, lowering entry barriers, or slowing speculative demand. But no single policy fully reverses decades of accumulated price pressure quickly because the underlying forces remain powerful. If cities continue concentrating opportunity while supply remains limited, demand pressure returns. If rates fall sharply, borrowing expands again. If investment capital seeks stable assets, property often remains attractive. This is why many housing reforms improve conditions only gradually rather than immediately transforming affordability. Another important realization is that housing markets do not move uniformly. Some regions cool while others remain expensive. Some cities expand supply more effectively than others, and some countries manage affordability better because policy reacts earlier to demand pressure. But globally, the same pattern appears repeatedly. Where economic opportunity concentrates faster than housing supply expands, prices rise beyond wage growth over long periods. That pattern explains why housing frustration now appears in so many different countries at once. It is not a local accident, but a repeated economic outcome in modern urban systems. And perhaps the most important perspective shift is this. The housing crisis is not only about expensive homes. It is about time. People increasingly feel that ownership requires more years of work, more years of saving, more years of waiting, and more years of financial discipline than before. A goal that once felt reachable after several working years can now feel postponed deep into adulthood, even for people with stable employment. This changes how entire generations think about family planning, mobility, long-term security, and even career decisions. When ownership moves further away, housing stops being only a market issue and becomes a social one because it affects how people imagine stability itself. The next time someone says owning a house feels impossible, they may not simply be reacting to one expensive property listing. They may be reacting to an entire economic system where prices respond faster than wages, where land near opportunity remains limited, where debt determines access, and where housing carries financial meaning far beyond shelter. Once that becomes visible, the modern housing crisis stops looking like a mystery and starts looking like the natural result of many powerful forces moving together for many years. And that is why, in so many cities around the world today, a house can feel less like something people buy when life becomes stable and more like something stability itself now depends on reaching.